Hello and welcome. My name is Benoit Poliquin. I am the founder and one of the portfolio managers here at Exponent. So, a lot of questions around, okay, Benoit, I now understand some of the underperformance that's going on with professional money managers, including Exponent. So, how does this end? Not well is the answer. So, let's look at history a little bit and let's go back in time. And let's go back to the early 2000s, the last tech of the boom. Now, history doesn't repeat, but it rhymes. But I think we need to look at what happened in the past to better understand what might happen in the future. So here we have our typical chart. This is the S&P 500 at the end of March of 2000. The S&P 500 closed at 1,500, peaked at 550 in mid-March, up 2% for the quarter. And 194 names of the end of the 500 are up and 300 are down. So it's not very broad in terms of what's up and what's down. So we call that a lack of breadth and upside down in terms of the advanced decline. That's not a good sign. And what you're seeing here in terms of these are the largest contributors to the positive move, the up 29 points or 2%. So we have a lot of technology names here. Some you may remember, like Nortel or Texas Instruments, Oracle, Cisco, Intel. And these moves up are in 3 months, 60%, 44. These are massive moves. You would expect over a 5-year period, you're getting them in 3 months. Mostly dominated by tech. And over on the detractor side, what's interesting is you're seeing a couple of what used to be dominant names, Microsoft and Nokia, down, okay, decent numbers. But then you're having companies that have no business being down this much. Procter Gamble down 48% in 1 quarter. Johnson & Johnson losing a quarter of its value. Same with Coca-Cola at 20%. You have Walmart losing 20%. Again, imagine that. The largest retailer in the U.S. losing 20% of its value in 1 quarter. So clearly, investors are jumping on the tech wagon and leaving a lot of the sectors behind. A stodgy old, the pharmaceutical business was really suffering. Largely, a lot of it was political because back in 2000, the companies like Schering-Plough or Merck or Bristol were going through, the U.S. was going through healthcare reform. So let's look at a lot of these names that typically should do well or at least flat are actually getting hurt. Sound familiar? So let's go back again. End of 2000. Let's look at the S&P 500 and how it was made up. It was made up of mostly technology name. Similar story. Tech dominates. The top 10 stocks, the first 10, they make up 25% of the index. The top 20 stocks, I have the 25 stocks here showing you just because I wanted, it was interesting. The bottom 4 were all technology names. So a lot of technology. The top 20 names are all tech. Again, sound familiar? And the top 20 names represent 25% of the index. So technology represented about 25% of the index. The total market value was $12.4 trillion. All right. So what are we looking at now? So the end of 2024, I'm just recapping that a little bit. So a lot of technology. Very focused, and notice the weights, how high they are compared to the top of 2000. I remember when I was just getting started, I started running money professionally in September of 99. So these weights, I remember distinctly, were a big concern for many investors because we just couldn't match the same weights that the indices have. Sounds familiar? It's only worse. 6.5%, 6.3%, Nvidia at 6%. We've got 8% in Google. I mean, they split it 2 ways, but basically it's the same company twice. Meta, 2.5%. You have to get to number 8 before you get sort of down to decent weights in terms of representation and risk metrics. So again, today, top 20 represent 47% of the S&P 500. Tech, of the top 20 names, 8 of them are tech. The weight of technology in the top 20, 37%. It's the same number as 2000, folks. So it took 3 years. I remember this distinctly. As I said, I started running money in 2000. And it was a godsend because I had no technology. I had nothing. I was getting started. So it took 3 years for the technology bubble to finally run its course. At the end of March of 2003, the S&P 500 was down 37%. The market cap was worth $7.8 trillion. We went from 12 trillion to 8 trillion. So as a money manager, yours truly stayed away from technology. It was pretty simple. That was the first thing you needed to do. So if we look at the weights, Microsoft still dominates, but the market cap, the market value is down 51%. Same for GE, which used to be a high-flying stock. And then you get into interesting situations. ExxonMobil down 14, and then you're starting to looking at the winners. Pfizer 36, Johnson & Johnson 76. Remember 3 years earlier they were the dogs of the S&P 500? Well, it turns out 3 years later you made a ton of money with them. Procter & Gamble up 54%. Now we can argue, well, it was down a lot in 2000, so you're kind of cherry picking the numbers, but be that as it may, the point here is how does underperformance end, or how does a bull market end? There's a market rotation that happens where investors will move from the hot stocks as they're hurting them into the things that are undervalued. That is the normal course of action. Verizon up 2%. Wells Fargo, banks, pharmas, another PepsiCo up 35%. Chevron. So on it goes. You've got a rotation that happens. Even though the total market capitalization comes down, there's ways to make money, and typically having a discipline. So the lesson of yours truly is that technology growth is immutable, but investors will always overcook the valuation of this growth. They think that growth will last forever. And so they kind of seeds they seed their own demise in a way. So fiber optics, web applications, websites, all of these things which are ubiquitous today. Companies like Apple and others like BlackBerry or even Amazon today, they benefit from these companies or these technologies, but those technologies are built on the tools that other companies built. Cisco, Nortel, Nokia, JDS Uniphase, that, effectively most of them don't even exist today, or they exist under a different life. So that's the lesson. The lesson is valuations matter. Technology companies are, by their very definition, working on their own demise because they're moving things forward. And investors love this growth, and then they overcook this growth, and basically that sees the demise of investors. So things like volatility, managing volatility, developing trading skills, having a valuation discipline, those were key early in my career. And any money manager that came through in the early 2000s or survived the early 2000s had to develop those skills. However, when the markets are roaring, that's exactly what creates your underperformance. So what's the lesson here? The lesson here is that underperformance always sorts itself out, but it's painful. You have to really be nimble, and you have to accept to move on from what the winners will be. And that is really the lesson here. Even if you have some of these winners, great, fantastic, but you need to move on at some point. And there's lots of ways to manage this. So underperformance ends typically when your capital stays intact while the investment landscape takes a drop. So outperformance really comes from capital protection. That's the lesson. Thank you very much for watching, and we'll speak to you soon.